When to buy stocks? What are the signals you can use to invest your money and get the highest return possible? In this video, I'll explain 2 investing strategies for when to invest, strategies that will work for any type of investor. I'll then give you 5 signals you can use for what stocks to buy. We're talking buying and selling stocks today on Let's Talk Money.
Beat debt.
Make money.
Make your money work for you.
Creating the financial future you deserve.
Let's talk money.
Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the community. Thank you for taking a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now, one of the most frequent questions I get from you in the community is when to buy stocks. How do I know when to buy a stock or when to invest in the stock market? And I get it. There are so many strategies out there, from value investing to momentum and just that idea of trying to time the market for higher returns. I think I've experimented with every one, both in my personal portfolio and then as a professional analyst. And like a lot of you, I haven't always made money. Now, I remember using the momentum strategy in my early 20s. So finding stocks with that upward strength in the price and then investing on that continued trend. Now, this was early in 2006, and I was up 20 grand in just the first 4 months of the year, so doing really well. But I remember this strategy so vividly because I took the week to visit my mom in Louisiana. She had moved down there to help with that post-Katrina cleanup after Hurricane Katrina, so I surprised her for Mother's Day. That week, the market broke down hard. The S&P 500 started sliding, taking these momentum stocks down even harder, and ended up with an 8% loss over the month. My portfolio absolutely tanked. I ended up losing that 20 grand in profits and another 5 grand before I ended up abandoning the strategy. Now, I've also used some of these factors that I'll reveal in this video to pick the stocks in our dividend portfolio challenge for that deep value theme. That portfolio is up almost 26% in the first 6 months of the year, beating the market by more than 7%, plus collecting a few percent on those dividends as well. So in this video, I'm going to explain 2 schools of thought when it comes to buying stocks. We'll look at one strategy where you're always buying stocks, but we'll improve on it with some things that you can look for to find the best stocks to buy. We'll then look at a timing strategy where I'll show you the signals that you can use to decide whether to invest your money right away or maybe hold off for better prices. Now, this first philosophy says that you should be buying stocks all the time, okay? Whenever you have money to save, you're using that to buy stocks in your account. Now, I'm a big proponent of using the business cycle and other signals for seeing stock market weakness over maybe the next 6 months or even further out, but you will never time a stock market crash down to the day or even down to the month. I see so many investors try jumping in and out of stocks almost on a daily basis on what they hear on TV or on the internet that it just eats up all their returns. Now, it's a big part of the reason why the average investor earned just 2.6% a year on average in the decade to 2013 versus a market return of 7.4% and even a 4.6% return on bonds. That's actual research from Dalbar. The average investor misses the market return by almost 5% because of these bad investing decisions. So if you're constantly buying stocks, you're going to be getting the best and the worst prices together. You'll invest at the top of the market and maybe feel a little bit of pain when stocks slide, but you'll also be investing at that bottom for a huge upside when stocks do rebound. And this is the strategy I think most investors do best with because it's low stress and low time commitment. Now, you find a handful of companies that you believe in, invest regularly, and then let the market do what it does best over that long run. In fact, I've created a video of forever stocks with 3 universal forces that are going to be driving the stock market over the next 30 years. These are the stocks that you can buy and hold forever, and I'm linking to it in the video description below. But where this first investing philosophy really falls short is that that leaves so much return on the table. Now, I love that it helps develop that habit of constantly saving and investing, but it really falls short as an investing strategy in itself. And also, improving on this, I like to change that question from when to buy stocks to what stocks to buy. Now, with this strategy, you're still investing regularly, but you shift that focus to continuously finding the best investments. You're still putting your money to work and not trying to time the market, but this is just going to give you the opportunity to look for stocks with maybe a little bit better upside than the market or assets outside of stocks. So here, I'm going to reveal 4 rules you can use to help boost your returns in this always investing strategy. After that, we'll move on to that next investing philosophy and some great ideas in using it. Now, our first rule, and this is something that we've talked about before on the channel, is to always be comparing stocks within that same industry or the sector. This means on the factors that we'll look at next, you'll always be comparing tech stocks with tech stocks and banks with banks. You're not comparing the PE ratio of a tech stock against that of a bank or an insurance company because they are completely different animals. So here's a chart of the 11 sectors of the economy and some of the industries in each. Things like profitability and market multiples are going to be widely different across these sectors, so you really need to be comparing similar companies against each other. This next rule or way to pick stocks is going to be one of the best measures you can use, but unfortunately not the most popular. This is going to be the profit margin. Now please don't let a little math scare you, because this is by far the best single measure you can use to pick great companies and great stocks. The profit or operating margin is a company's operating income. That's on its income statement divided by the revenue it made over that same period. Let's look at a quick example because this is super easy to find, and you'll see why it's one of the best measures that you can look at. We're here on the income statement for Apple, so that's ticker AAPL, and this is the quarterly financial statement that shows how much in earnings the company booked. Now I'm using Morningstar here, but you can find these financial statements on the company's own website by searching for investor relations or any investing platform that you use. At the top of the income statement, you've got revenue or all the sales booked over that period. Now we see here that Apple booked over $265 billion in sales last year. From that, they take out all the cost of materials and these supplies for that gross profit number or gross margin. Then they list out these operating expenses. Now these are all the costs to run a business. So you see things like research and development, new products, you've got sales and marketing costs and administration. Now this all came to almost $31 billion and left the company with this operating income line in about $71 billion. This is the company's operating profit, the money it made on that business. Now I know that everyone loves to look at the net income or the earnings per share, but that's skewed by the company's use of debt and taxes and sometimes no small amount of financial shenanigans. The point is that if you take this operating income, that $71 billion, and divide by the revenue, you get a pure measure of business profitability. That's almost 27% for Apple, and when you compare that percentage against other competitors, you get a very clear picture of which company's management is able to produce the best results. Now, I want you to replay that walkthrough here if you need to, but finding that operating margin is super easy once you've got the hang of it. This is the single best way to compare companies. It's not that price to earnings ratio on the stock. It's this measure of how each company's management is at producing profits from the business. Now, our third way to pick better stocks here is going to be comparing growth in actual cash flow and net income. Now, this is another one that's going to take a little bit of digging into those financial statements, but this is the best way I know of finding accounting shenanigans and real quality earnings. Bear with me because I promise this is going to be like second nature after you've looked at it once or twice, and then we'll look at an example to make it a little bit clearer. So here we are back on the income statement for Apple, and we see that this net income, or the bottom line for earnings of the company, here it says Apple made its investors almost $60 billion last year, and when we compare that to that number in 2013, we see that the company has grown earnings by 61% over that 5-year period. Now understand that you can compare any year on this. I usually like looking at a 3-year and a 5-year comparison. Now we go to the cash flow statement, one of the other financial statements reported by a company, and honestly, this is where professional analysts spend most of their time. You see, where the income statement includes all kinds of accounting gimmicks and tricks that a company can use to make its earnings look better, the cash flow statement shows actual cash in and out of the company. Now, of course, there are ways to fudge cash flow, but it's a lot harder to do. So this is a great look at the actual cash generating power of a company. In this top part of the cash flow statement, this cash flow from operations, or CFO, this shows the cash in and out of the company on those business operations. Now listen to that again because it should jump out to you as hugely important. This line down at the bottom, this net cash provided by operations, this is the cash the company generated from the actual business. So if we do that same thing here, comparing the 2018 CFO or cash flow from operations against the 2013 number, we see that Apple has grown it by 44% over the period. So this is hugely important as a measure of quality and earnings for a company. You see that 60% in earnings growth reported by Apple on the income statement, but actual cash generated from the business has only grown by 44% over those years. So what gives? Somehow Apple is reporting to investors that its earnings are higher than the actual cash coming into the company. Now it's using some kinds of accounting tricks to boost those earnings numbers beyond what that cash generation would say. Now before I get a lot of comments from Apple out there, this doesn't necessarily mean that the company is using some shady accounting here to inflate its earnings or even to pull one over on investors. There are some basic accounting differences that mean your net income growth and your cash flow growth is never going to be exactly the same. But the closer these rates are, the higher quality that earnings growth is going to be. Seriously, this one measure, this one cash flow growth measure, comparing these growth numbers, is going to help you pick better stocks and avoid some of the worst frauds out there. Using this one measure, you would have seen problems in Enron before the company bankrupted. That's on the extreme side, but the measure also is going to help you avoid some of those companies with poor quality earnings like IBM and a stock price that just goes nowhere for decades. This fourth measure for what stocks to buy is going to be more familiar, those price multiples like the price to earnings ratio, but there's a big warning sign here. So price multiples like the price to earnings ratio that you hear so often about on TV and on the internet, these are just a number of times the stock price is over some financial result like earnings or cash flow. These are measures of how expensive a stock is and really a so-so measure to compare with other stocks. Now, using the price to earnings ratio or some of the others that I'll list out quickly here, you get a feel for relative value in a stock. Now that word relative is super important, but it's one that you don't hear much when you hear pundits talk about these price multiples, so I want to emphasize it. Comparing price to earnings of two stocks is going to tell you that one is relatively cheaper than the other. So a stock with a PE ratio of 15 is cheaper than a stock with a 20 PE ratio, but none of this says anything about the stock's value or if it's a good investment. It might be that the stock with a 15 price to earnings ratio is cheaper than the other stock, but still not a good investment. On the other hand, both of these stocks, even the one with the higher PE ratio, might be good investments after all. So the other warning here when you're using these price multiples, so again, taking that stock price divided by a financial result like earnings or revenue or cash flow, I would much rather you use something like that price to sales or price to cash flow or even price to book value than that more popular price to earnings multiple. Now, I understand these aren't talked about as much as that price to earnings ratio, but we've already talked a lot about how management uses every trick in the book to fudge its earnings numbers. It's much more difficult to fudge revenue or cash flow, so anytime you can compare a price to sales ratio of two stocks, you'll get a much better comparison. So using these four filters, these four criteria, you're going to be able to pick better stocks even if you're not trying to time the market. You're still investing every few months with your savings, but maybe you're not investing in the same stocks every single time. You're finding the best stocks to buy right now with these four filters. Now I want to go over that second investing philosophy, the idea of waiting the market out sometimes for the best moments to buy stocks. First though, I want to open this up to the community too. Do you think investors can time the market? Why or why not? So scroll down and tell us in the comments below, can investors beat the market by timing the stock market, by timing when they buy stocks? Now that second philosophy of when to buy stocks is much more still that when question because it says you don't have to be buying stocks all the time. The idea is that when stocks do get expensive or even certain times of the year, you can keep your money in cash and then invest when there's a better opportunity. Now I know there is a lot of skepticism around this kind of timing the market strategy, but there are actually some very real data to support parts of this philosophy. Now proving this is something that we've talked about on the channel before and absolutely shouldn't work, but it does, is that sell in May phenomenon in stocks. Now the idea here is that the 6 months from May through October are historically the worst for stocks. You see here that the 62 years through 2012, the only 4 months to post average losses were during this period, during this May through October period. So the strategy says that you sell or at least pull back on your stocks at the end of April and hold cash until November. Now I put the data together here for every year over that 62-year period. The left 4 columns is the return on a $10,000 portfolio invested each year during that May through October period. So here we're only investing during those 6 months and then sitting in cash the rest of the time. These middle 4 columns, on the other hand, are the exact opposite here, investing only in that November through April period. So this is actually that sell in May strategy because we're holding no stocks during that May through October period and then just investing only in November through April. Finally, the last 3 columns are that buy and hold strategy. So investing that $10,000 in 1950 and just holding on until 2012. And the results are truly amazing here. Investing during that 6-month period between May through October of each year, those 6 worst months, you would have actually lost you money. You would have had just $3,286 left of that $10,000 portfolio after these 62 years for an average loss of 1.2% annually. Now the buy and hold portfolio, so basically the stock market return over those 60 plus years was 8.1% on an annual basis. You would have finished 2012 with a little under $645,000 from that initial $10,000 investment. But look at the middle columns, that sell in May strategy where we're only investing from November through April of each year and then sitting out the rest of those months. You would have finished 2012 with almost $1.9 million. That's an annual return of 9.3%, more than a percent above that buy and hold strategy, and for a simple strategy of sitting out half the year. Now, there are a few reasons why the market is typically weaker from that May through October period. It's not just random chance, but I want to get to 3 ways that you can use this timing information. So I'm just going to link in the video description below to a video explaining why that sell in May strategy works. Now, another useful way that I've used to time when to buy stocks is just following the business cycle. Unlike the stock market, which is totally batshit crazy most of the time, the business cycle actually follows the economy and some fairly obvious signals. Now, the business cycle doesn't match up perfectly with the ups and downs in the stock market, but they do tend to move very closely together. So following these signals in the business cycle, you not only get a better idea of just general stock market weakness or strength, but it can also tell you which stock sectors are going to outperform at certain times. Now, I just published an entire video explaining the business cycle investing strategy that I use and going through all that data, so look for that link in the video description below as well. Now, there are 2 things that you can do with this kind of a strategy, this waiting the market out strategy, 2 ways to hold your money while you're waiting for better opportunities in stocks. The first strategy is just going to be holding more cash and bonds. Now, this is what I'm doing right now. So mid-2019, I've got about 15% of my wealth in cash, which normally it would be closer to about 5%, and another 20% in bonds, which that would normally be closer to maybe a tenth or maybe 15% of my wealth. The idea here is that even if the stock market keeps going up, you're probably not missing out on much upside. By holding more in cash and then those safer corporate bonds, you've got that cash reserve to put it back to work when stock prices do come down. These times when you're sitting out the market are also a great time to start your own business or invest that money in your business assets. The return on a business idea is going to be far and above what you'll ever make in stocks, especially if you think the market is expensive right now. Don't miss that video on forever stocks. 5 stocks you can buy right now for massive returns over the next 30 years. So click on the video to the right to check those out now. Don't forget to join the Let's Talk Money community by clicking subscribe and tapping that bell notification.